if you could just do that, and then I will do that. It says let everyone know they're being recorded. So what I'll do is I'll share my screen here, and then we'll get right into it. Perfect. Right. Everyone can see the screen, all good?
Yep.
Perfect. Good.
I'll start off by thanking everyone for attending, and for those who are watching the recording afterwards. Thank you very much for participating here. I've sent out this webinar, which is an exciting one because it's a program that is new, and it's offering people the opportunity to actually transition from being a renter or a first-time home buyer into home ownership, where normally people are struggling these days to find the down payment to actually buy something in this expensive city that we live in. So I hope you benefit from this, and either yourself or a family member or friend can actually use this program to benefit them to get into home ownership. So having said all this, I'm looking forward to this presentation. Zach and David are our presenters. They are from the Vine Group, and I'll pass the mic over to them.
Perfect. Thanks so much, Andre. Everyone, welcome to the Vine Group Down Payment Program webinar, hosted by myself. I'm Zach, and David Gonzalez, my CEO. Exciting time to partner up with Andre and his clientele to offer this program to you guys. So why Vine Group? You know, we have over $2 billion funded last year, between 70 agents. That's a lot of mortgage volume, which is good. Just speaks on behalf of everything that we have going on at Vine Group. And we're national, so we're in Toronto, Montreal, Regina, Winnipeg, Edmonton, Calgary, and Vancouver. We have Dave. He's mortgage broker and founding partner, 20 plus years in the mortgage industry. And myself, 5-year mortgage agent, funding over 500 million. And then we have Andre, who we rely on for everything real estate, 20 years in the real estate industry, finding, creating investment properties as well as portfolios. So some exciting times to talk about, our down payment program. And, we partnered with a company, a real estate investment fund that created this company called OurBoro. So everyone, I just want you to meet OurBoro, and we'll kind of get right into it. So here's OurBoro. And OurBoro is a company that assists clients with down payment up to $250,000 for beneficial interest in the property's equity. Okay, so what does exactly that mean? Well, what they're doing is they have come together, and as I said, they're an investment fund, and they said, we're willing to offer you a minimum of 5% down payment to up to 15% of your down payment for future equity in your home. So there's no monthly payments, none of that. It is strictly future appreciation of your home. So if you purchase a home for $1 million, whatever the appreciation is for the next X amount of years, that is the beneficial ownership. That is the appreciation that they are looking for. Okay, so some things to note about OurBoro. It's not a regular loan. They do not sit on title, and they don't lien the property. The major areas that they're working in right now is Greater Toronto Area, Hamilton, Guelph, Kitchener-Waterloo, London, and then they have plans to come in to the Ottawa market shortly. There's 2 lenders that they specifically work with, which is Community Trust and Equitable Bank. I'm sure some of you have heard of them before. So a couple things that OurBoro wants people to meet the following criteria. So are you a Canadian citizen or a permanent resident? Well, yes. Are you looking to buy a home in one of our investment regions that we just spoke about? Well, yes, Toronto mostly. Are you purchasing a home as a primary residence, either a condo, single family, a duplex, or a triplex? Are you purchasing a home between $550,000 and $2.5 million? Are you able to invest at least 5% of the home value towards the down payment at the time of the purchase? And are you able to qualify for the mortgage amount needed to buy a home with one of our approved lenders? Once again, Community Trust and Equitable Bank. So here's how it works. Simple numbers, we'll break it down, and then we'll get into an example. So we have the home purchase. We're going to go with $1 million. The down payment needed is 20%. Okay. Here's the home buyer contribution of 80,000 or 8%. And then OurBoro, they come together and say, all right, we're going to give you the remaining 120,000 for a 12% ownership. So here's how they split it up. So the home buyer, I mean, if you just divide these by 2, technically, that's how you get the 8%, right? So you have the 40%, and then OurBoro's a 60% owner. Okay. So what that means is from the $1 million to putting 20% down or $200,000, they've contributed 120,000 and the home buyers contributed 80,000. So what they do is they receive a beneficial interest in the future appreciation of your home in proportion to your contribution towards the down payment. So in this example here, OurBoro is investing only from $1 million and on. Their initial capital that they have of the 120,000 of the equity in the home, that's the initial investment. And anything above and beyond that, they're going to maintain 60% of that. So let's just say in the first year, your home's worth 1.1 million. Technically, they would have a $60,000 ownership in that appreciation. Okay.
So, Zach, just to clarify on that, you put in $200,000 in total.
Yep.
$80,000 is yours. 120,000 is OurBoro's.
Yep.
Then you have an $800,000 mortgage.
Correct.
Whatever you pay down in terms of mortgage principal, is all yours, 100% yours.
100% yours. 100%.
So the only thing that the OurBoro is actually a beneficial owner of is the appreciation part. So $1 million and above.
Correct. That is exactly right. So anything that you pay down, so 800,000 is the mortgage. Anything below that is completely yours. Anything above that $1 million threshold appreciation is that beneficial ownership that you split.
Right.
Okay.
And I do want to encourage, if anyone has any questions, you can put it in the chat or you can unmute yourself and feel free to interrupt and ask your question.
Absolutely.
May I ask one real quick?
Absolutely.
Yep. So with this, since they have majority ownership too, is it like, since they're an equity owner, do they get any other say in like things you do? So say if you have tenants or certain payments to do, or if you want to sell the house, like do they also have to have a say in what that happens because they have majority ownership?
No, so they're a co-owner. They don't have majority ownership. I mean, on paper they do, but they're a co-owner. So anything that you were to do, so if you wanted to renovate the home, you go ahead and renovate the home. If you had a duplex or a triplex, they don't have any say in that. As long as you're paying that mortgage down and that house is going to continue to appreciate, that's what they're banking on. That's their business model, right? They're investing in real estate. They don't have any desire to be landlords. Their desire is, hey, we have this structural home and we think is going to grow continuously over the next 5, 10, 15, 20, 30 years. And that's our goal.
Gotcha. Thank you.
Okay. Perfect.
One more quick question following
Yep.
that. Is there a timeline that they work on, or it's, a long-term thing for them?
Yeah. So OurBoro's willing to invest up to 30 years into you, which is a lifetime of a mortgage normally. The max mortgage or amortization in Canada would be a 30-year amortization technically. So they're willing to invest up to 30 years. But the goal as a mortgage agent, such as myself or Dave, our goal is to pay OurBoro back as soon as possible. So, there's a couple ways to do that, which we'll get into. We're relying on, appreciation so we can refinance that house or sell that house and move on to the next one, where you actually create now you're the majority owner and OurBoro is a minority owner in the property, as well as a refinance, right? So if you continue to pay down that principal on the mortgage and your home appreciates, there might be some numbers that work where we can refinance that home, you can pay OurBoro back, and now you're 100% owner. Okay. Perfect. So here's the purchase. that we're going to go with. So we're going to use the same numbers, other than, you know, I think it's beneficial to go the 50-50 split here. So John is looking to purchase a home for $1 million and has $100,000 to use as a down payment. He's looking to put 20% down or $200,000 to avoid CMHC insurance, which if you purchase a home for under $999,999, you can have an insured mortgage. Anything above that has to be a conventional mortgage where you need 20% down. So John has the first 10% of the down payment, and his broker has contacted OurBoro for the remaining down payment of $100,000 or 10% to get him to that $200,000. So John currently has a 50% ownership in the equity of the home, while OurBoro has a 50% ownership as well. In 3 years, John has paid down his mortgage to $750,000 and decides to sell the property. He receives an offer for $1.3 million. So let's see exactly what that looks like. So right here, we have the original purchase price of $1 million. The sale price, $1.3 million 3 years later. The existing mortgage, because remember, he paid down from $800,000 to $750,000. So that capital is his. So $750,000. The total equity that we have right here is $550,000 available. Okay. So the initial OurBoro down payment plus land transfer tax was $100,000 and $16,000 for the land transfer tax, total of $116,000. And just a little tidbit of where we got that $16,000 is for $1 million home in the GTA, core GTA, your land transfer tax is going to be around $32,000. So when you put down 50% and whatever OurBoro puts down, is whether it's 50% or 25%, you guys are splitting the land transfer tax, however the beneficial ownership is. So if you put down 5% and OurBoro puts down 15%, they'll cover 75% of the land transfer tax and you only cover 25%. Okay. So we owe them $116,000 plus the appreciation from $300,000, which is the 1.3 minus 1 million. And we did divide that by 2, which is 150,000. So the total amount owing to OurBoro is 116,000 plus 150,000 for a total of 266,000. So the remaining proceeds that John has to work with is $284,000. So how I got that was I took the total equity of $550,000. I subtracted $266,000, which is owed to OurBoro, and that left him with the remaining proceeds. So, you know, at his initial $116,000 investment, right? Because remember, he put down $100,000 as well as $16,000 of the land transfer tax. It is now $284,000 from the appreciation and paying down principal on his mortgage. I would say that that's a pretty good return in those 3 years. So we're really relying on appreciation in the market, which, you know, we'll get into the details, but that's the way things are looking to go based on the data.
So Zach, if you're looking at this and you're selling it after 3 years or 5 years, whatever it is, but if the only way to get out of this OurBoro program is by selling it, is there another option for us?
Yeah, of course. So what we can do is, in this case, we can refinance the mortgage. Okay. So we'll get into, this gets us into our OurBoro refinance. Okay. So the goal is to pay out OurBoro as quick as possible to ensure you have the greatest opportunity at having 100% equity in your home. That's the end goal, right? So we don't want OurBoro to have 30 years of appreciation of all our hard-earned money and everything, and appreciation and living there and everything that we do. We don't want them to have all that. Okay. So the down payment a client would need to get for a refinance to make sense would be 10%. So that's kind of the trigger rate and the sweet spot of the purchase price. On $1 million purchase, we would need $100,000, which a refinance would make sense because in the grand scheme of things, the appreciation that does happen, we would have 50% of that appreciation rather than if we were only to put 5% down or 50,000, OurBoro would have 75,000 or 75% of the appreciation. It's very hard to refinance in that case because of the limits that we have in Canada on refinancing a mortgage. So if you're familiar with, purchasing or refinancing a home, you can only normally go 80% loan to value, especially on a refinance. 100%, that is exactly how it is. You can only go 80% loan to value. Okay. So let's get into the number. Yep.
So just to be clear, 80% loan to value is 20% down.
20% down, exactly.
Yeah. Awesome.
Yeah. Okay, so here's our refinance based on the same example, same numbers, and this is how it works. So you have the original purchase price of $1 million. John goes out and OurBoro find an appraiser and a realtor and say, the market value of this home is 1.3 million because that's what he can sell it for. The existing mortgage that he has is he still paid it down to 750,000. The initial OurBoro down payment plus land transfer tax remains the same of 116,000. The appreciation is 300,000, doing the multiplication. So we still owe them 150,000 from the appreciation, and the total owing to OurBoro is the 150,000 of appreciation plus the original investment of 116,000 for a total of 266,000. So the available equity we have to refinance would be 1.3 million times 0.8, which is 80% loan to value on the property, for a total of $1,040,000. All we need is 266,000, but available to us because the mortgage is paid down to 750, we have 290,000. So if you see what I did here, we have the $1,040,000 minus the 750, which gives us 290,000, but we only need 266,000
to pay out OurBoro.
to pay out OurBoro. Exactly.
So you
Okay,
have.
so if you love your home, you have a solution, right?
We have a
Love your home,
solution if you
don't
love
wanna
your home.
sell it,
Exactly.
yeah, basically keep the house.
Correct. Does anyone have any questions regarding that? No, all good.
Just
Yeah.
sorry, just a question on refinancing in general. So yeah, you would use this deal besides selling as an alternative to get
Yep.
out of the OurBoro to pay them
Yep.
off. But also when refinancing, does it, I guess it depends on the time, but it wouldn't like change your mortgage rate or anything, right? It would just increase the overall mortgage you have to pay, correct?
So this is something that we would look at. We would try and line the sit down meeting with a mortgage agent. It's a discovery meeting, right? So you figure out your timeline and what you're looking to do. Obviously, you can't time the market with everything, but with B lenders, more times than not, such as Community Trust and Equitable Bank, more times than not, they don't have good porting policies like Scotiabank or TD Bank. So unfortunately, we would probably try and line this up perfectly, the best we can. Your rate would more than change, but it might even be better. Who knows, right?
All right, gotcha. But that's like the only real downside to refinancing in this case.
That is correct. That is correct.
Gotcha.
But then again, moving from Community Trust or Equitable Bank to someone like TD, Scotia, that is completely possible to do so in this scenario, as you're no longer working with OurBoro. So, let's just say your income increases and you're paying down some sort of debt that you have. This is a situation where working with someone like myself or Dave gets you to that next level of, we're going to kind of guide you how to right, the best way to go from the Community Trust and Equitable Bank to a TD, a Scotia, a BMO, right? So I don't think there's a downside. I think there's more so of an upside and an opportunity to kind of get better terms.
Yeah, that's true.
Okay.
Thank you.
No problem.
It's actually harder to qualify when you have OurBoro on there than not.
Yeah.
So you
Gotcha.
should be easier to refinance than it was to qualify.
Yep. Absolutely.
Gotcha.
Awesome.
Okay, so a big thing that we want to talk about is, what does it look like if we put based on the $1 million purchase price, what does it look if I only put a 5% down payment or $50,000 down payment? In this case, as you're paying down your mortgage. So it's tough exactly to tell you, like it's very tough to tell you exactly what it looks like. But based on our numbers that we, created to refinance, if you were to put 5% down, your home value would have to increase from $1 million to 1.7 million to pay OurBoro back, just clean. That is very tough in a short period of time. As I said, maybe over the 10, 20, 30 years that this might happen, absolutely. But if you're thinking short term, that's very tough to do it. So if you're thinking, you know what, I'm going to use OurBoro and then I'm going to refinance and pay them out immediately, that's very, very tough to do so. The sweet spot, as we spoke about, and that's where our examples come in, is the 10%. If we were to put 15% down payment to pay out OurBoro, our home would only need to increase to 1.15 million to pay OurBoro back. I think that's pretty realistic. I do think sometimes it is tough to come up with that down payment, and that's okay. But talking to someone like myself or Dave, I do think that there's going to be a solution for everyone, which is good. Okay.
So guys, the end goal there is very straightforward. It's refinance and pay out OurBoro as fast as possible, regardless of what your down payment situation was, right? We don't want to carry the loan longer than we have to. Obviously, the less you put down, the longer, the more the property needs to appreciate over time, right? So we want you to pay it off as fast as possible. You can maximize the benefit of home ownership without
Absolutely.
on your loan.
And also, this is all reflecting the refinance option. Remember, the first option we talked about is selling it, which you don't have to wait till it appreciates to 1.7. You can, like the example that you gave was that it appreciated to 1.3, and you pretty much almost tripled your money.
Correct. Exactly. So this is strictly for a refinance. So hey, I fell in love. I found my dream home, and this is exactly where I want to stay.
Yep.
Okay.
Okay.
So, a lot of people probably haven't heard about OurBoro, and that's okay. This is relatively new, but here's some sort of guidance from a big five bank that is kind of helping us legitimize OurBoro, which is good. So the program is different, but the fundamentals kind of remain the same, that you're borrowing credit, you're borrowing money to purchase a home. Okay. So the Bank of Montreal has created a down payment assistance program, which allows clients to borrow money from, an unsecured personal loan or line of credit. A lot of people have lines of credits, gifts from non-immediate family members. Previously, they only wanted it from your mom, dad, brother, sister. Employee assistance loan programs. Not a lot of the lenders recognize this, but some businesses do have loan programs, or even private loans with fixed repayment terms. So these qualified borrowers can borrow up to 10% down payment towards their home purchase. So we put this slide in to legitimize OurBoro and say, you know what, the big banks are veering towards borrowing money to use as a down payment on a home, and that's okay. So this example is good for, someone who maybe is a doctor or a lawyer who have they're a young professional who have those large lines of credits from when they were in school for 7-8 years, and they have that the liquid access available to them to draw on those lines of credits. Okay, so this isn't for everyone, but as I said, the point of this slide is to make sure that everyone realizes that this is becoming a normal thing, and that's the reality of, I guess, the future with the way home prices are and the minimal savings because life is expensive in general. Okay. So let's talk about Toronto real estate, and I'm going to let Andre jump in here, but in the last 5 years, home values in the GTA have increased over 35%, and in the last 10 years, home values have increased 117%. That is a very high number, and there's no signs of this slowing down. And as much as we've been in kind of a weird market, immigration is still at an all-time high, that we are not building enough homes to keep up with this. So CMHC, which is down here on the left, is the Canadian Mortgage Housing Corporation, and it shows that Canadian home prices will increase by 89% by 2030 due to high demand and lack of supply. We're not building homes fast enough, and I can't put enough emphasis on it that there's just not enough homes for people, and people are always going to continue to buy homes. You need somewhere to live. It's been one of the best investments for decades now, and I do believe, and OurBoro, that's their business model, they do believe the exact same thing. Andre, did you want to jump in and talk about your experience in the real estate industry?
Yes. So one thing I do want to point out is CMHC is referring to the Canadian average home price will increase by 89% by 2030. So we're talking about the Canadian average, which is very different when you compare to the Toronto average or the GTA average or Hamilton or Ottawa. Those regions have outperformed the Canadian average by a long shot. And that's why OurBoro chooses these investment regions to fund, because they believe in those regions. They believe in the Canadian market. They believe that appreciation is the way to go. And they're putting basically their eggs in that basket. So that sort of tells you that they have faith in the market. These two B lenders who are agreeing to this see it as well. Otherwise, they wouldn't be agreeing to this. So that is positive signs, in my opinion. Now, when you want to talk about immigration, you want to talk about foreign students, you want to talk about the population growth, all that is factoring in the growth of demand and the lack of supply, which I know you have a slide that's going to be touching on that.
Yep.
We can get to that in how much of a lopsided situation we're in. The amount of demand and the amount of supply, it will not come to a balance anytime soon.
Right. Yeah. So as you can see, the CMHC housing supply. So this is something they came out with late last year. And this is their projection that Canada is projected to be short 4 million homes by 2030. So you got to think, we're already in 2024. We have 6 years to continue to build homes. And their projection is the way immigration is and the way demand is, we're going to be short 4 million homes. What makes this even crazier is CIBC came out with a news article yesterday, and they actually increased it. And they said by 2030, Canada is going to be short 5 million homes. So not 4 million like CMHC originally projected. CIBC, a big 5 bank, said we're actually going to be short 5 million homes. The CMHC data is very conservative. That is going to, in itself, drive prices through the roof.
And since you guys are mortgage brokers, you might even want to touch on what will happen when interest rates start creeping down.
Yep. So the natural trend is, home prices and interest rates, they work alongside each other. So as interest rates start to come down, we see a trend of increasing home prices. So we've even seen that in the last, call it 3 months, which is crazy, that as fixed rates start to come down, and I'm not talking about the Bank of Canada rate right now. I'm talking about fixed rates that people are following that are in the low to mid 5s now. People are saying, wow, okay, that's not that bad. And the demand for our services and the demand in open houses and has just significantly increased. Yes. So
all this points to justifying how values will continue to rise and why OurBoro chooses this strategy for investing their money.
Correct.
Yeah, look, the short-term reality is as rates come down and stabilize, you're going to see a ton of pent-up demand come off the shelf, because we saw record lows last 2 years, and there's a ton of buyers that were just naturally waiting to jump into the market. We got cold feet and then didn't move. They're going to come in as rates go down, and then you have just a natural segment of people who are, they want to upgrade because maybe the lifestyle's changed, or they want to move from a rental to a buyer because they have kids, they got married, whatever that case is. That natural life cycle, we're all still going to be in the market. So in theory, we might see twice as many people looking to buy homes in the next 12 to 18 months than we normally would even 3 years ago when we were at our peak activity.
Exactly.
So
Yep.
supply and demand is just a reality. Yeah, there's not enough supply to meet demand. So you're going to naturally see prices rise as people's purchase power increase with rates coming down.
Correct. So as we're talking about housing supply, I mean, I think it's a good idea to kind of jump into, you know, what rent looks like. You know, nobody wants to, as much as we all love our parents, nobody wants to live with their parents forever. You know, they purchased their home 30 years ago. We know prices have significantly increased, and we all have that joke that, you know, they bought it for pennies on the dollar now. So when you're looking at the average rent, according to the Toronto Real Estate Board, so average rents across the GTA jumped 8.6% to $27.42 per month. That's over $32,000 per year allocated to rent only. You know, and if you have a good paying job, that's great, but you're still paying $32,000 of that to something that you will never see. It will never come back. So a 1 bedroom, which is obviously small, was up 12.7% annually. The 2 bedroom was up 9.8%. And, you know, the GTA rents are 42% higher than the national average. GTA is very core. There's a lot of stuff going on there, which is great. But it is possible with OurBoro for you to purchase in the GTA, as this is their main focus and this is where they reside. So as rents continue to increase, we're going to see home prices continue to increase, and more so than not, we'll probably see rates come down slowly as the market continues to adjust everything. So I do think that, you know, after, if you guys want to send an email to everyone, and we can kind of discuss, maybe do a sit down and discuss how you're either going to get out of your parents' place or get out of your rental and become a buyer. Or if you're a landlord, we can offer this to your tenant as well, because a good thing about this is we always want to get you market prices for your rental, because they're continuing to change so much, right? So here's a basic chart that just shows you since December 2021, rent has increased over, you know, $600-700 a month. So another thing that we're going to focus on is not only in the down payment, but a lot of clients have bruised credit, and it's from things that were done years ago. You know, maybe they were in college, university, or maybe they just forgot to, you know, make a couple payments, or even they forgot that they were paying something with their credit card and the credit card got lost, or they just forgot to pay it. So Chexy is a company that is actually allowing you to pay your rent with your credit card. And what they'll do is they will report you paying rent on time to Equifax, which is the biggest credit holder that you can think of. So a good part about this is they will take whatever you pay with your credit card, whatever rent you pay, they'll pay your landlord for you. You get the rewards on your credit card, but they'll also report that you paid rent to Equifax, which is only going to increase your credit score. So a couple perks, the rewards on rent. Chexy is one of the first companies in Canada to allow you to pay rent with a credit card. You can earn cash back, or, you know, airplane points, any of that kind of stuff. So whatever credit card that you have, there's a calculator on their website actually that shows you what credit card you have and why it makes sense to use Chexy. The Credit Builder, which is the Equifax partnership, it's only $7 a month. They'll automatically report your on-time rent payments to Equifax and boosting your credit score for paying rent every single month. So these guys and girls, part of the company, have done over 60 million in transactions in the last 7 months, that's how many Canadians are starting to use Chexy. It's becoming a very big thing, and I would encourage you to look them up. And if there's any questions, let me know.
Will they report non-payments?
Yes.
Absolutely. So this is very
it's a
beneficial to
deterrent.
landlords.
It's a deterrent against somebody who might not want to pay your rent, right? If a tenant is willing to report to Chexy, they're obviously looking to pay on time.
That is correct.
And yeah.
So for landlords, this becomes a, hey, are you willing to use Chexy? I'll cut your rent by a couple bucks a month. That's how you know that, you know, and I would never say guaranteed, but 99% sure, right?
Yeah.
Your confidence goes up, way up.
Exactly. Okay, so Andre, I'll let you take it from here for the questions.
Okay. So if anyone has any questions, again, you can unmute yourself, ask a question. You can type it in the chat box. But I'm going to start off with the first question. That's Zach, Dave. You know, who exactly is OurBoro? Is it some person that you guys know that's, you know, behind or in front of you at the desk there, and he just has a large lump sum of cash that he's willing to lend out? Who is OurBoro?
Yeah, so OurBoro is a real estate investment fund. So if you can think of someone that like a private lender that pools all their money together and then lend that out privately. OurBoro is a similar business model, but their sole focus is appreciation in the market. There's no catch. So their business model is strictly, hey, we're going to give you between 5 and 15% of your down payment. So either 25% or 75% of the beneficial ownership of the equity in your home. Currently, it allows you to get in the real estate market, but we want the same return back. And that's our expectation, that the real estate market is going to continue to appreciate the way we think it's going to. And that's how we're going to make a ton of money.
Okay.
Okay.
Yep. And we already covered, yeah, go ahead, Dave.
No, I was just saying it's simple. You know, OurBoro is basically structured a program where the property pays back the loan.
Yeah.
So they feel very confident they're going to get their payout. What we're trying to do is take it a little bit further and say, let's create a plan and a strategy. So we're not paying them 30 years down the road. We're going to pay them in a shorter window. They're still going to make money, but also as a homeowner, you're going to be able to take over control and take control of your equity.
And I think that's one of the most attractive features about this program is that your monthly fees don't go up because of this. You basically, that extra 15% or that the 15% down payment or 10%, whatever that you cannot put up, that's just like, you're not paying anything for that. That's like, you know, here's a free money and you're paying the mortgage based on that lower mortgage, that 80% loan to value. And then when the property appreciates, then you pay them back when you sell or refinance, which is a great thing.
Yeah. So they're saying is you don't pay us back, the home does.
Right. I'm going to jump to a question where it's, what if the property, okay, let's talk about worst case scenarios.
Yeah.
Because that was one of my questions when I first was talking to you about OurBoro. I was like, so what's the worst case scenario here, Zach? What happens if in 3 years from now, my goal was to actually buy out OurBoro, but something happened? Maybe I'm an entrepreneur, I'm a self-employed individual, and my business went down and I can't pay him out, or the property values actually went down. So let's just say we bought it for $1 million and 3 years later it went down to 900,000. What do you do? What happens? Okay. And I want to sell.
Yeah. And so if you want to sell, so I mean, if the first example, if you want to buy them out, and you know, business isn't going well, then you would just sell, right? So that's fine. You're free and clear there. The problem is if the home depreciates in value, they're a co-owner. There's no, hey, we're putting all the onus on you because you own the home, like you live in the home. That's not how it works. So I'll give you the best example here. So if you purchase for $1 million and in 3 years you sell it for 900,000, your mortgage goes from 800,000 to 750 in that example that we use. So you've paid off $50,000 of principal. You still get that $50,000. That $50,000 is yours. And the beneficial ownership, so say it's 15% and 5% down. So in this case, OurBoro does 15% and you do 5%. you would split the equity in the home, and they're taking a loss, as well as, I mean, technically you'd be taking a loss as well from the equity in the home, because you've actually paid down that $50,000 from the 800 to 750. So they're a co-owner. There's no, you're both taking the risk. You both take the risk together. So they're understanding that, you know what, we actually might not get our money back, and that's their motto. That's okay. Obviously, that is not something they believe in, or they wouldn't have started the company. Nobody goes into business to lose money. But worst case scenario, based on those numbers, the client would get, from that 800 to 900,000, the client would get $25,000. OurBoro would get $75,000. And then the client would get the additional 50 from paying down the mortgage from 800,000 to 50,000. So technically, they would both walk out with $75,000.
Okay.
Okay.
Yep. And OurBoro does not have a say as to when you can sell.
They do not have a say when you can sell. No, obviously that is the risk that they're willing to take.
Okay. So again, we're talking about 3 years, Mark, but what happens if I want to, you know, stay on longer? Whether it's to my benefit or not, it's working for me. I have a home that's growing for me.
Yep.
Can I stay there for 10 years with OurBoro?
Yeah, absolutely. And as we mentioned before, they're willing to invest up to 30 years. If you want to live there for the next 30 years, and when you pay off your mortgage, that's something that you can absolutely do. They're willing to invest up to 30 years.
Okay. And now you mentioned OurBoro. It's not a lender, it's an investing fund, but the two lenders that they're partnered with, are they A lenders, B lenders, and can you tell us a bit of the major difference between the two?
Absolutely. So in this case, OurBoro has partnered with two lenders, as we spoke about, so Community Trust and Equitable Bank. These lenders are both B lenders. So the difference, when you think about it, an A lender is someone, you know, the big five. That's who we always think about: Scotiabank, CIBC, BMO, RBC, TD. Those are who have the most market share in Canada. Those are strictly A lenders. And then on the B side, you have Community Trust, you have Home Trust, you have Equitable Bank, you have Optimum Mortgage Group. These are smaller lenders that offer rates that are a little bit different. You pay about a premium of about 1% higher on the annual mortgage rate, and there's always a lender fee with them. So the lender fee is always 1%. So whether you take a 1 year, a 2 year, or 3 year term, the lender fee is always 1% for that set term. So in this case, if your mortgage is $800,000, you have to pay upfront the $8,000 fee. Some people like it, some people don't. That's the reality of getting into the real estate market right now. As mentioned, you know, a B lender is not forever. The A lender is where, working with Dave and myself, is where we want to get you. Frankly, we don't really like to use B lenders, and it's not like there's anything bad. Some people are strictly B lending for life. We just feel that it's easier with an A lender to kind of manage things, and they obviously offer better rates, and we're more inclined to provide better service to the clients because we're getting you a better rate. We're still going to provide the exact same service, but the initiative for us is we just want to get you the best rate and term possible, and we can do that with an A lender.
Okay. Now, when it comes to investing in this program, are we not taking too much of a risk banking on appreciation to pay off OurBoro? Like that's speculative, but
for sure.
Is it too risky to do this?
So I don't think in this market right now, I don't think there's a risk factor. I think the more so risk is sitting on the sidelines and not getting in the market and taking advantage of this program. And the reason I say that is, you know what, as you know, in the real estate market right now, the competitive advantage is people going out to look because there's so many people on the sidelines. So there's more risk sitting on the sidelines paying rent or living with your parents and not paying down that mortgage principal to, you know, better your future and to make some sort of investment moves, right? So I think that right now, the way you get into the market with OurBoro is, you know, you go through the approval process, you go through with Dave and myself, and then you go through the approval process with OurBoro, and you don't have to provide any documentation. It's just a meeting. That's all it is. They'll call you, they'll have a discussion with you about where you're looking, and they'll say, hey, you know what, you're approved. It's more so going to be us on our side providing them the documentation that you've already shared with us. So OurBoro is very transparent on the expectations. Like Andre said before, there's no monthly payments. It doesn't affect your monthly carrying costs. You're becoming a homeowner. You're getting your feet wet in the market, and whether you're going to be there for 1, 2, 3, 10, 20, 30 years, this is definitely the easiest way to go without you having to save, you know, that $100,000 or that extra $50,000, because, you know, as crazy as it is, it's very hard to do so nowadays. So I wouldn't say we're taking too much risk banking on the market. We have the data to support the way the market is going. And as soon as the Bank of Canada starts cutting the rates and fixed rates as well start to trend downwards, I do think we're going to see a favorable jump in the market, you know, due to the housing supply that we talked about, due to the immigration that's coming into this country.
What happens if OurBoro, you've invested with them and you're in year 2 or whatever year you're in with them, and all of a sudden OurBoro goes, I don't know if the right term is bankrupt, or they decide to you know, jump ship.
Yeah.
Are we protected?
So you're protected in a way that the group of investors that create the fund, they will never go away. They will never run out of money. That's how confident they are. OurBoro is a subsidy, and that's kind of the front of them. So the side agreement that you have that they're helping you purchase this home, that will never expire until you pay them out. The existing company has been around for, you know, 35 years, and I spoke to them the other day, and they said we're looking for the next 35, right? So they will never go out of business because of that core company that they have.
But even if they went out of business, they can't force you to sell.
So of course not. No, there's no forcing you to sell.
That's their problem. If there's creditors waiting to receive the money after you sell or after you pay them off, that money, where it goes, is irrelevant to you. It has no impact. It doesn't matter if they're solvent or insolvent for you. It doesn't change any way of operating and going about your business.
Okay. What about if someone, I had someone ask me this today, should I wait until interest rates go down to buy something, or should I take advantage of this program and buy now?
Yeah, I would say the data that we provided and the data that's out there, I would say the way the market is going is over the next 24 months, rates are going to start trending downwards a couple percent. And like we've mentioned many times, home prices are only going to go up from there due to the lack of supply, due to the high demand, due to the interest rates. And as we said, it's kind of like a teeter-totter with, you know, home prices versus rates. You know, as rates go up, home prices kind of stay stagnant. They drop a little bit. If so, as soon as rates start to trick down, and, you know, over the last 3 months, as fixed rates have come down, we've seen a lot of action. We've seen house prices actually continue to increase, especially from January, you know, 2023 to January 2024, if we're doing a comparison.
Like, for example, what's that phrase where it says date the interest rate and marry the house?
Yeah, date the rate, marry the home.
So is that?
Yeah,
so,
we coined that one.
Yeah.
Yeah.
So what exactly does that mean? Like, is that telling you, hey?
It's simple. Rates are going to change. They're volatile, right? You can't make a decision just solely on interest rate. Home values seem to be going up on a consistent basis. So while you're waiting for a rate to come down, your home value might increase well beyond what that interest rate differential is. So you could end up in a situation where you actually sat so long that you priced yourself out of the market. Yeah, the rate's better, but if the purchase price went up, it might no longer be able to be something you can catch up to. But I've been this for a long time. Like 15 years ago, you could buy a condo for $250,000, you know, in Toronto. And I'm not talking like 300 square feet. I remember when 500 square feet were considered micro condos, and the banks would even touch them 15 years ago. So that was like 800 square feet. You know, imagine getting 800 square foot condo today in downtown Toronto for $250,000. You know, 10 years ago, you could buy a bungalow for 350 grand just off the Danforth. You know, walking distance some fabulous restaurants, you know, right by the subway line. And today, good luck buying a bungalow for $350,000. You know, that was just 10 years ago. So clearly the market's moving in this direction. This isn't isolated to Canada. This is a global reality. Big cities all around the world, not just seeing immigration, they're also seeing migration. So when they talk about immigration numbers, what they're not putting in there is migration. There's a lot of people migrating from other parts of the country into the cities. So it just keeps swelling. And you have a massive supply and demand. And the one thing that no one talks about, and I don't know why they talk about, here's the real sad reality. Even if we could financially build all those houses, we actually physically can't do it. We don't have enough labor, you don't have enough concrete, you don't have enough steel. Physically impossible. So the home supply demand curve isn't going to get fixed anytime soon. You probably won't see it in our lifetime. So when CMHC says they think home values are going to basically double over the next 8 to 10 years, well, that's what it did prior to. So why wouldn't it do it again?
Yeah. I want to open up. Anyone have any questions that they would like to ask Zach, Dave, or myself? You can unmute yourself. Oh, Greg, go ahead. You can unmute yourself.
Hey, so my scenario, my oldest daughter, she's in university renting. My son's about to go to university in the fall. They're going to Guelph, so we've been looking. Does it make sense to buy an investment property there? And I guess the term that jumped out at me was principal resident. So how would that work? Like, would the kids have to be the principal resident? Do they have to qualify on their own, or what are the loopholes or workarounds to all that good stuff?
Yeah, so it's like a general mortgage. So yes, they would have to qualify. But in this case, technically it would be a principal residence for them. You would just have to most likely co-sign with them. You would also be a co-owner, which they're willing to do in this case.
Oh, really?
Yeah.
Even though, like, for example, if Greg owns his primary residence right now and he can still co-sign it, it would still work with our.
Yeah, technically it would be his family within arm's length principal residence.
Okay.
Yeah. So it would qualify because of the relation between just 1 degree.
Yeah.
So we would obviously have to take a look at that. You know, it's a little more complicated when you're on your own property. Not so much with OurBoro, more with the lenders. So we'd have to take a look at that and run the scenario. But technically, it doesn't disqualify you.
Absolutely not.
Yeah. Okay. Your kids do need to be able to contribute to the repayment. So they have to have some type of employment and income.
Correct.
What about
questions?
What about paying out OurBoro at any time? Can you do that without a penalty?
Yeah, absolutely. If you have the funds to do so, like if someone has some sort of inheritance or any of that kind of stuff, or the market appreciates that much that, you know, we can pay out them with what's owed, the appreciation and the initial down payment that they provide you. You absolutely can. As mentioned before, there's no, you know, there's no catch. There's no hidden fees. This is just, they are investing in you now. They're investing in the home now for the market appreciation later.
Is that buyout, like what sets the appreciation on the property? Is it an appraisal or the current market value determined by what?
Exactly. So if you're going to refinance the property, OurBoro and the client there would be two separate things. So the lender that we were going to choose, we would get an appraisal, but OurBoro has their own realtor that they would also send out, and they would probably do a dollar cost average based on that and say, all right, this is where we think it is, just so it's fair for both parties, right? They're not saying, hey, this place is worth 1.5 when your neighbor just sold for 1.3 million, but you got hardwood floors and they have, carpet. That's not the reality of it. But
Yeah, appraisals are pretty governed. Like
Yeah.
it's very
Yes.
rare you get a massive swing in price.
Yeah.
You tend to see more of a differential in value when there's a major shift in the marketplace. So values are going down, and two appraisers appraise it. One of them might be forecasting and saying, well, the value is going to go down lower, so I'm going to appraise lower than the other one. If values are on a steep rise and they just came off the bottom, you might see two appraisers come in at a different value. One saying, hey, I'm going to give again the increased value because the values was on the rise. The other one might say, well, we haven't quite seen enough history yet for me to do that. So I'm going to give you something that's more in line with the immediate transaction.
Yeah.
But once we see steady consistency with home values, even if they're rising or dropping, then the appraisals tend to be pretty much the same across the board. It's rare you get two values that are way off. When I say across the board, we're talking less than 2% generally.
Yeah.
And you did talk about terms. There's 1-year terms, 2-year terms, 3-year terms. They're pretty standard.
Typically with a B lender, we're going to recommend, to keep it pretty short, especially right now where rates are on the decline. We'd probably be looking at a 1-year term. We wouldn't necessarily suggest to go into a 3-year term. If we have to renew that B lender because we're not paying OurBoro in that meantime, the good news is, we'd want to pick a B lender who does not charge a renewal fee. So you're not going to pay that 1% fee again, right? You pay it the first time up front. We might have to renew for 3 years just to make sure that we have enough equity built up to pay out OurBoro. And at that point, we would refinance and look at other lenders as an alternative. Now, that being said, we can have that conversation right up front. It's not like when we sit down right now at this stage, we can't say, okay, let's pre-position kind of what the future looks like, and let's assess what needs to happen between now and then in order to have the most optimal alternative, right? So what is it that we need to do in order to go from to pay out OurBoro, first of all. Secondly, go from this lender to a better lender at a lower pricing, better terms, and so forth. Right? But let's remember, if you're self-employed and you don't want to pay a lot of taxes, you're probably going to be a B client for life. But you can weigh those two options as well, right? Sometimes paying a little bit more on the rate is a lot better than paying a lot more in tax. So we can have that conversation too.
Yeah, and that's one of the reasons why I really thought this program was a great option. Many people I know are self-employed individuals, and they don't. A lot of them sometimes don't have that large down payment that you need in order to buy something, and sometimes they don't claim enough income to qualify with an A lender. So there's two issues there. But with OurBoro and the lenders that they're partnered with, this now becomes an actual option for them, and they can actually get into the game.
Yeah, because the B lenders are going to look at things a little bit differently, right? They're going to look at not just your filed income, they're going to look at your financial activity, right? And might not necessarily be represented in your credit bureau, but it's represented in your bank accounts, right? So we'll take a look at those bank accounts for 6 to 12 months history. Keep in mind, most of them do, they say 6 months, but they generally require 12 months history. And they want to see what expenses are coming out, how much are you actually spending. And then we want to basically reverse engineer that for them as basically a financial statement saying, hey, this is the real cash flow, right? And they land on that. And if you're maintaining your rent and you're maintaining all your other expenses and your credit is still satisfactory, you're probably going to be an ideal candidate. The reality is B lenders were 10, 15 years ago, they were a lender who basically dealt with subprime clients who had very poor credit, clients who had maybe previous bankruptcies. Today, they still want to service those clients, but that's not their core business. Today, their core business is clients with good credit, but like you said, Andre, don't report the income that is required to qualify, but have the cash flow to actually service the debt.
Yeah.
Another thing you have to remember is that default rate in Canada is almost non-significant. So when they talk about the default rate increased 3% or 30%, well, it's still not 1%, so it's irrelevant. it's so irrelevant because Canadians tend to pay their homes and their mortgages first before anything else.
Yeah.
That's right. Well, look, if there's any other questions, please unmute yourself. You can ask away. Thank you guys for attending. I will be sending out the recorded video for anyone that's not attended, or even the ones who have attended. You'll have a copy of this. If you want to reach out to David, Zach, or myself with any questions you have, feel free to do so, even if it's questions you want to ask more about the program, or even figuring out if it's right for you. Thank you again. I think this was great. Thank you guys for sharing this program with us. I really appreciate it. And you guys are always great with all your wisdom and information experience. Thank you so much.
Appreciate it. All right, guys. Thank you so much for listening. And if anyone does have any questions, please feel free to email myself and Dave, and we'll get back to you immediately. That question on Guelph, Greg, that you spoke, I'm more than happy to discuss that.
I'll show you an email and we can connect.
Perfect. That's awesome.
Yeah, my daughter's going to Guelph next year too. My youngest.
Guelph all the way.
Yeah, that's good.
Cheers, guys. Have a
All
good
right,
one.
guys.
Bye.
Thanks so much.
See ya.
See ya.
You guys stopped the recording.